Good morning, and Jambo to all of you. Honorable PS, National Treasury Dr. Chris Kipto, DTB Chairman Linus Gitai, and board members present, distinguished speakers, invited guests, ladies and gentlemen. It is my pleasure to welcome you to the 5th DTB Economic and Sustainability Forum, a platform where we engage in meaningful discussions about Kenya's economic landscape, emerging market trends, and the role of sustainability in shaping long-term prosperity. Allow me to extend my sincere appreciation to all of you for joining us today. The forum has grown over the years to become a critical space for thought leadership, collaboration, and forward-thinking strategies. Each edition has provided valuable perspectives, and today's discussions under the theme Outlook 2025, Positioning for Recovery in a Fragile Environment, could not be more timely. We are honored to have distinguished speakers with us here today, and I want to especially acknowledge our chief guest, the Principal Secretary, National Treasury, Dr. Chris Kipto. Honorable PS, the Treasury's leadership in economic policy continues to play a vital role in strengthening Kenya's financial landscape, and your presence here this morning reaffirms the importance in shaping Kenya's economic future. At DTB, our role extends beyond financial services. We believe in partnerships that create long-term value, supporting businesses not just through financing, but through strategic insights, advisory, and sustainability-driven solutions. Throughout today's sessions, you will hear from thought leaders, industry experts, and our own leadership team who will provide insights into how businesses can position for recovery and long-term success. To take us deeper into this conversation, it is my privilege to introduce Murali Natarajan, our new Managing Director and CEO at DTB Kenya. Murali joined us 3 months ago, bringing with him a wealth of international experience in banking, finance, and economic strategy. Having worked across multiple markets, he understands the intricacies of emerging economies, the challenges businesses face, and the opportunities that come with the strategic growth and financial inclusion. I have no doubt, Murali, that this leadership will strengthen our collective vision for growth, and that his insights here today will be invaluable as we discuss Kenya's economic outlook and DTB's role in supporting businesses. Ladies and gentlemen, please join me in welcoming Murali to the stage. Thank you.
Jambo count for more than 80% of employment as per whatever information I have been able to gather. I believe retail and MSME lending is poised to take off, and it's only a matter of time. DTB intends to intensify its efforts in the segments like retail and SME in the coming years. We are aiming to double our balance sheet between 3 to 4 years. What I have learned is that in order to create a lasting organization, a business must embrace 3 qualities without fail. This is what I've learned through books and through my own experience. 1, adapt and keep growing. 2, Balance between stability and innovation. Be methodical in the changes that you make. And 3, be socially responsible. So once again, our intention is to double the balance sheet between 3 to 4 years. Moving on, in the short period that I've spent in DTB, I'm impressed with our commitment towards sustainability and citizenship. And let me give you some examples. We have planted 552,700 trees in Kenya. 552,700. But that's not all. Our aim, target, is to reach 10 million trees by 2030 in just 5 years. Right? That's a huge commitment. And with Mr. Al Karim, I'm a member of the Sustainability Committee, and I know the kind of efforts that we are making and will continue to make. We have mentored several women on financial literacy, and we continue to do so. We have provided sanitary pads to 24,000 girls in the schools, which has allowed them to attend schools more regularly. And these are all obligations towards a greener tomorrow. I want to assure you that while taking DTB business to greater heights with the same zeal and enthusiasm, it is my duty, responsibility, and intention to pursue our sustainability goals as well. It has been a pleasure talking to all of you. Thank you for your attention. I now invite Mr. Linus Gitahi, Chairman DTB, Asante Sana. Thank you.
Our chief guests, Mr. Chris Kipto, our distinguished customers, our staff, ladies and gentlemen, good morning. Good morning. Naona kama watu hawajapata breakfast vizuri. First of all, let me say that Bwana Munari came here. I didn't even know it was 3 months. I thought it was longer. We've done many things together. We've met in the office. We have played golf together. What I forgot is that he comes from India, and there's this small business of horoscopes. So the man has been seeing what is going to happen to me the next 6 months. He has never told me. He's probably just quietly laughing at me. So after this, we are going to have a formal session where he needs to detail what is going to happen to me in the next 6 months, and it had better be good. But welcome, Mr. Morari. The institution of ACFED, the institution of AKDN, has been around for close to 100 years, probably 100 years. And this institution has evolved. We have institutions like Serena, we have institutions like Nation Media Group, we have institutions like Jubilee Insurance, we have Diamond Trust Bank, and many, many other institutions. It's a huge institution, probably responsible for, as an institution, is probably the biggest employer in Kenya. This institution has been driven by His Highness the Aga Khan, and recently we know that we had the passing on of His Highness the Senior, and now I would just want us to probably stand up and have 1 minute silence in honor of founder of these institutions, that family, and the community. So in honor of the Aga Khan, His Highness the Aga Khan, let us observe 1 minute silence. gentlemen, may his soul rest in eternal, perfect peace. Let me now take this opportunity, first of all, to introduce my fellow directors of Diamond Trust Bank who are present. I want to introduce Ivan Kavalji, who is standing over there. I want to introduce Pam Agal, Chair of Human Resources, sitting over there. Any other director present? Of course, we've got our Karim. Our Karim is our finance director and a board director, and of course, we've got a group CEO. Is there any other director who I may not have seen? Thank you very much. Now, I do not have a lot to say after that very good speech by the group CEO and by our Kenya MD. I just want to say just a couple of thoughts. One, when we talk about sustainability, especially resilience, which is what the theme of this conversation today is about, my mind goes back to when I was in GlaxoSmithKline and I was export manager of the company. And when I was export manager, we are talking about 1992, 93. I know now people are asking about my age. I would go to Tanzania and I would go to Uganda. When I went, in fact, I would drive, and I did drive many times. When I went there, and I think there are many other people who could have done that, 90% of the products in a typical shop in Tanzania, Kariokoo especially, which is a core business area, and Shikubo in Kampala, which is a core business area, 90% of the products were from Kenya. I still go to Tanzania, I still go to Uganda. In fact, in both places, I've been there in the last 3 months. And I still went to Kariokoo, and I still went to Shikubo. Today, less than 10% of the typical shop have products from Kenya. I think, ladies and gentlemen, that is a challenge that is facing us. We need to have a conversation, and I think these are the right forums, to talk about what we need to do to sharpen our competitiveness. Because ultimately, our sustainability is dependent on how competitive we are. In 1992, our competition was basically looking at Tanzania and Uganda and Rwanda and Ethiopia. Today our competition is global. In fact, those products that were there have not necessarily in Shikubo and in Kariokoo, and by that I mean Tanzania, have not been necessarily replaced by Tanzania products or Uganda products. They have since been replaced by products from Tanzania, from South Africa. They have since been replaced by products from India, China, and all those other places. What do we need to do? I think what I find in this country, and thank you very much, Bwana Kiptu, for coming. I find a finance, a treasury that does very well, does a lot of work. I can tell you, I don't need to ask Chris because I know him well. These guys burn the midnight oil. And then you other guys burn the midnight oil. We are all trying to do a little bit. I want to suggest that it is time we came together now and start asking ourselves, where is the shoe pinching and what do we need to do together to make our competitiveness better? What is it that we need to do to ensure that globally now we can push the products? It's not just about products and services coming from South Africa, which, by the way, I know there could be South Africans in the room, is not as competitive as Kenya. What is it that we need to do to now go into those spaces, whether it is services and whether it is products, and begin to fight Kenyan products and services in those places? That is a conversation that we ought to have. That conversation is not a private sector, companies, banks alone. It is our joint conversation. And therefore, I thank you, Bwana Kiptu, for being here today. So that, because when we talk about sustainability, we talk about life beyond us. We talk about how life will be long after we are gone. And in this specific area, then we need to have that joint conversation. And when we do, I suggest or I suspect that when that joint conversation is held, there are two conclusions that are likely to come, or there are two areas that we need to think about working together on. One of them is how we can all drive our costs down. Because ultimately, if our costs are down, then we have a better chance of better pricing of our products and services for the rest of the world to consume them. And when our costs are down, the second conversation that we'll then be having is about how to drive our volumes in whichever space that we are in. And if we do those two things, if we drive our costs down, which leads to driving the volumes, then I suggest that our competitiveness is going to be better. And I want to say, one of the persons, hate him, love him, have whatever opinion you have, but he has recently become president of a country called America. His name is Trump. That is the language Trump is talking. You hate him or have whatever opinion you have, but he's talking about America first. He is saying even these USAID manenos and all that. Why, by the way, USAID, what is it doing in a country called what? Kenya? Let's first of all sort out America. Are we going to have that conversation about let us sort out Kenya? Let us actually sit together and say Kenya can do it. We can sit and moan about USAID, or we can drive volumes, we can drive our economic activity beyond the borders, beyond East Africa, and actually make ourselves a lot more competitive. I really hope that that is some of the conversations that we are going to have, because the world is changing. The time for getting those bits of handouts, I think, is going to be behind us. It is our hard work, it's our resilience, which is the theme of this conversation, that is going to move us forward. It is, unfortunately, fortunately for us, when you talk about Kenya, in this region, we have one of the best human resources within the region. We have some of the best. Our young people, our Gen Zs, have actually proven to be world beaters in many, many spaces. What are we going to do again, sitting together with government, with the private sector, to harness those skills and actually have a time when some of these people come, whether it is Trump, and we tell him, yes, thank you very much, but we actually don't need it. We actually don't need it, because we're able to generate our own. I look forward to these conversations. I look forward to the conversations being very long-term, and I look forward to DTB doing its bit to ensure that that sustainability that we dream about is realized, because we exist. Thank you very much, ladies and gentlemen. It's my pleasure to do it. Ladies and gentlemen, let me now invite a good friend of DTB, our PS in the Treasury, a man who actually, like I said, works very hard to ensure that ends meet in a difficult environment. So, Chris, I don't know whether you are there during Kanu days. Was used to say, Moja, Biri, Karibu, uongee na watu wako. Asante sana. Thank you very much.
Thank you very much, Linus Mitaid, Chairman of DTB, Kenya. Or the group chairman, okay? I meet quite often. These are the roles. I think for inviting me, together with the MD for Kenya, is it Murali Natarajan? I got it right. I see also the regulator, Timothy Kimutai from Central Bank. And let me recognize also all directors of DTB Group, the board of directors, and everyone who is here. Good morning. Hamjambo. And when I came in this morning, I was asked by my team that they have made a presentation that I should make instead of reading a speech. So Meshach, is it there? Or I can go ahead and... Yeah, so most of you must be, I think you know me well. I've been around. I started my career at the central bank, worked many years at the central bank. While there, I was seconded to a number of institutions, IMF, capital markets, and the office of the Prime Minister. I think I met Karo Kariuki at that time, and we've been around together up to now. And then I resigned. I went to Trademark East Africa for 3 years before I was reappointed. I was appointed as PS. In trade for 4 years, environment for 3 years, and now I've been at Treasury for 2 years, 2 months. I must say, of all those, what I'm holding now, the position I'm holding now is the most difficult. This is the outline of my presentation. It's going to be a short one, and I start because Kenya is just within the group, we are integrated with the international economy. So we always like to indicate how things have been, and I like the use of the tree, strong tree, because I think Kenya has been a strong tree. We have a domestic, a global economy that has performed since the COVID. We saw in 2024 the GDP for the world economy was 3.2%. And we are seeing this year going to 3.3%. So the outlook reflects stronger than expected growth, especially in the US and some of the emerging markets such as India. And in the sub-Saharan Africa, we also see a rebound of growth to 3.8%, from 3.8 to around 4.2% in 2025. And so, again, I want to come to the Kenyan economy. We have a resilient economy, diversified, and I think that's why we always come out of shocks. And last year, we have seen growth decline because of what we went through, especially during the Gen Z moment. And first quarter was 5%, second quarter was 4.6%, third quarter, when we had the riots, was 4%. And in the last quarter, we expected a rebound of around 4.6. So on average, the growth for 2024 is around 4.6%. And we saw the growth was primarily in agriculture. And quarrying didn't do well. Mining and quarrying didn't do well. And also construction subsectors. You will see housing has done well, but because the construction in roads and other sectors that require construction have also declined, overall construction hasn't done as much as we'd expect. But we have seen manufacturing also not do well. The growth is low, and it's not as we would expect given all the history that we have, all the efforts we have made previously. And I think I welcome the conversation, Gitai. We need to have a conversation about competitiveness, especially in our manufacturing sector. And I offer to take leadership in that conversation. So we will agree together on how to proceed. But services sector is one of those sectors that has done well, and you can see there in the numbers. I really don't want to spend a lot of time discussing them, but this is how we have come. 2019, you see where we were. 2020, because of COVID, we had a rebound, 7.6. Because of base effects, that was a good performance of 7.6. Then 4.9, we went to 5.6. Now we have come to around 4.6% average for 2024. And you can see we're expecting to be doing much better, around 5%. So, and 5% is not bad growth. Of course, it's not what we would expect, because we were aiming at growing at 10% as envisaged in our Vision 2030. Our macros have done well. In fact, I remember when I joined in, things were very difficult. It was one of my most difficult moments. I never had sleep. We used to stay up to very late. We had liquidity challenges. Auctions would fail. Sometimes every Thursday you are not sure whether you are going to collect enough to pay maturing bills. But me, I'm happy because when I look back, so much has happened, and sometimes people say you may be painting a bad picture, but I think I'm right to say the worst is over and that the future is brighter. I say this because when I look at where we have come from, look, inflation has come down, not just because of what Central Bank has done, it's also a combination of what we have done at the National Treasury. So you see, CBK has, through Monetary Policy Committee, has been making changes on the CBR, and even last week it changed the cash ratio requirement, and now it's at 3.2% in an effort to increase liquidity. And that has seen inflation come down. And I wanted to give numbers here because sometimes people say we don't see this inflation reflected in, and is it really affecting the pockets of Kenyans? And the truth is this: in January 2024, a kilogram of sugar was going at 209 shillings, and January this year it was at 161. So we have had a reduction of 23% in prices of sugar. Fortified maize, you can see it was 175 shillings per kilo. Now it's 2 kilogram of maize flour was going at 175 last year. This year it was 161 in January, about 8% decline. Wheat, 2 kilogram was 195 and it has declined by 13%. Kerosene has declined by 22%. Electricity cost has declined by 19%. And petrol has come down by about 15%. And the same also for diesel. And these are basic commodities. So clearly, if you had 100 shillings, it's buying, it's much worth now than before. And I think I want to now see this, because of inflation coming down, we have also seen interest rates drop, and interbank rates have come down. You can see now it's around 10.1%, and treasury bill rates, we are moving to single digit. In fact, I think this is the first time since the Kibaki era that we are seeing TB rates coming down, and we are hoping that this can be passed to private sector, people who are borrowing. You can see borrowing, credit to private sector had declined. But with this improvement now in the environment where interest rates are coming down, we expect that rates will go up. And we have seen this. We have seen commercial bank lending rates decline in December 2024 to 16.9 from 17.2 in October. And the changes that have been made, I've also seen banks adjust. We have seen core bank made adjustment, KCB, Equity, and Diamond Trust. I have seen, I hope I'm right, 87 basis points. Can we clap for DTB? So my message today is that commercial banks should do more to lower interest rates, because that way we can then be able to access more credit to private sector, and therefore be able to support growth. How have we done also on the external sector? We have seen the current account deficit narrow to be at 3.6% in December 2024 compared to 4.4% the previous year. And remittances have increased by 16.6% to about 4.961 billion US dollars. And then reserves have gone up to the highest level for the many years that we have been around. Now we are talking about 10 billion worth of foreign exchange held at Central Bank, covering 5.1 months of import cover. I remember when we came into office, we had difficulty for oil marketers getting US dollars. In fact, some of them would open accounts in every commercial bank to get even $5,000. It was very difficult. And it was because especially of the uncertainty about the settlement of the Eurobond, the 2 billion that was coming to mature in June. And many people were fearing that we were not going to be able to settle. But we were able to move to market to issue and bought back 1.5 billion of the same, and that was a major transaction that really changed things, because it de-risked the environment, and many people who were speculating found themselves now with a lot of excess dollars, because what we did was to issue and buy back. So we didn't really come in with any dollars. We just used and bought back. So a lot of people were found with a lot of dollars. And I think with central bank reforms, we have seen a lot of improvement. And I think what I see here is a reflection of CBK efforts and also at the National Treasury. So let's appreciate central bank especially for that. So, and the shilling was weakening, and I remember we were forecasting, some people were forecasting to reach 250, 260 shillings per US dollar. But that change, that action to go to the market in February is what changed everything. And we have seen that from then on, the shilling has appreciated from around 160 around that time to now 129, 130 for the last 1 year. I think that has also been very good stability. In fact, central bank has been buying dollars over the same period. You can imagine if it was not going to market to buy, what would have happened? The shilling would have even been more stronger. Perhaps it would have come to around 100 shillings per dollar. So again, let's appreciate CBK for the work they have done. Now, the most difficult part is the part on fiscal. Because fiscal, we are in a situation where we have debt vulnerabilities. Debt has increased and is taking a huge chunk of our resources. Then expenditure pressures are increasing, and Kenyans are reluctant to be on the side of revenues, because we talk about tax. You hear many people say we are overtaxed. This is the conversation we need to have, because we can't have our cake and eat it. If we have to run a budget that is approved, then resources also have to be raised, and we can only raise two resources by raising revenues or borrowing. We do not have the leisure to borrow more, and I'll be explaining to you as we go forward. So I just want to show you that we have implemented the budget since July. And you recall that when Parliament approved a budget that was very ambitious, we wanted to bring down deficit to 3.5%. So what Parliament approved was aiming to have a 3.5% deficit from around 5.6. And we had finance bill that was to give us an additional resources of 344 billion. But you recall what happened? There were riots, and what happened was that we had to go back to Parliament because we withdrew the president declined to assent to the bill, and therefore we had to revise the budget by the equivalent of 344 billion of what we lost. So we went to supplementary one, which was in July, and reduced the budget deficit, but we couldn't do much because we could not cut the expenditure by 344 billion, because it meant very important sectors like education would not be able to get resources. So we reduced the expenditure by half. The rest, it meant additional borrowing. That's why budget deficit increased from 3.5% to 4.3% of GDP. That's what was approved in supplementary. So we have implemented the budget, and we ended up in January this year with underperformance in revenue of about 92.6 billion. And this underperformance was more in July and August during the riots, because we lost almost about 60 billion shillings of revenues that we did not collect. So we because of the challenges of revenues, of course, the expenditure it meant that expenditure also was coming down. So you can see that we have some areas like ministerial A&A doing well, but overall revenues have not done as much as we would have wanted. Then, so we have proposed a supplementary now. We are going to supplementary 2. We just submitted this to Parliament, and in this supplementary 2, we are looking at taking into account tax measures that we took to Parliament last year. We presented to Parliament. We expected to raise about 175 billion out of what we submitted to Parliament, but Parliament did not approve all the tax measures we took. We got some of them, like Tax Laws Amendment Bill of 2024, Tax Procedures Amendment Bill of 2024, and Business Laws Amendment Bill of 2024. When we estimate, we expect some revenues of around 70 billion. So dividing this by half, this is what we have factored in this supplementary. So those are the numbers you see. Ordinary revenues are likely we are having a projection to 2.6 trillion, and this is lower than what we had projected in the supplementary one, because we want also to bring in realism in our expectations. So, and we have expenditure has gone up. We had 3.8 trillion when we went supplementary one, but because of spending pressures, you have seen riots, teachers want more salary, university loans, and other areas we have had to accommodate. So we are now talking about a 4 trillion, almost 4 trillion budget, and yet revenues are not moving as they should. So we have to really balance all, and in the next year's budget, we are looking at focusing more on better, which is really the programs that we expect, and we are focusing on the key areas of this government, which is agriculture, MSMEs, housing, healthcare, and digital superhighway. And we expect that we continue focusing on those areas. I really don't want to give you, I'll give you this presentation so that I don't have to spend time going through. But we are looking at more of agriculture exports. And so if you look down there, you see that we are looking at tea and other edible oils, cotton, where we want to see that we do some import substitution for edible oils, for instance. So these are some of the areas that we are looking at, the value chains that we are looking at: leather, cotton, dairy, edible oils, tea, rice, blue economy, natural resources, and building materials. So for the financial sector, this has been a sector that has done well. I know we have discussions. I was just telling Caro that we need to have a conversation, especially as we go to next year's budget. I think it would be good to discuss some of the measures. I know last year we came up with some of the tax measures that did not needed more conversation. But really, this sector contributes a lot to the economy, and we see in the central bank reports that the banking sector now boasts of about 7.7 trillion worth of assets. And I just want to say that we are looking at more of what you said, Bana MD, Morala, on SMSE. I heard you talk about 12 million figures for MSMEs. At the Treasury, we are trying to also see how to de-risk. So we came up with a credit guarantee scheme. And this scheme has 7 banks, including you, DTB, that we expect will work together to see that when you lend, you can lend to more risk sectors, because we have this credit guarantee scheme. Now we have gone to cabinet. We are transforming the scheme into a corporate company that will be focused more on guarantee schemes, and therefore we will be asking more working with you to support us on that. I want to, sorry, what happened? So I want to conclude by saying that we are looking at fiscal consolidation. And I don't know how many of you have been looking at our numbers. Maybe the best way is actually to look at this. If you look at 2013, from 2013 up to 2023, 2024, you can see revenues as percent of GDP have declined from 18 to 14. Over the same period, you have seen debt to GDP increase. In fact, our rating of debt sustainability has been like this. In 2013, our debt was considered sustainable. In other words, the debt distress was considered low. 2018, it went to medium. By 2020, it was rated high debt distress. In other words, if we did not do something, we would easily fall. So that's why in the IMF program that we adopted in 2021 April, it was going to focus on revenue-driven fiscal consolidation, because we needed to focus on increasing revenues and containing debt, because debt could not be accommodated more. So you can see therefore that going forward, we want to reverse and go back from the 14% up to the number that you see there is 15, but we want actually to move up to 2022, up to 20% And how do we want to do it? We want to do a number of measures, undertake a number of measures. First of all, we are going to do a lot of expenditure controls. Some of you may be aware, we have done a lot of reforms. We just merged 42 parastatals, and we are going through the merger. It's going to be tough, but we want to shrink because we feel that there is still scope there to make some savings, and while balancing to make sure that we don't also lose jobs, because it's a sensitive area that we have to handle. But we have a number of reforms that we have undertaken and continue to undertake as National Treasury. I really don't want to mention all of them here, but you can see we are adopting an e-procurement policy, for instance. We are strengthening our public financial management, where we are adopting zero-based budgeting. We are migrating from cash to accrual accounting. You will see that in our books now we have pending bills, but they are not captured. So first we want to clean the pending bills. Our pending bills verification committee is about to finish its work. So far it has gone through and has approved 206 billion worth of pending bills to be paid, and most of it is in the road sector. So we have advanced in ensuring that we sort out especially the road sector, and we expect in the next financial year to also put a good amount of what we have seen on especially the hustlers. Anyone below 10 million and below who is owed, we want to prioritize. And we have seen of the 206 billion that has been verified, 97% are entities that will require only 30 billion, so we're clear. And that we want to focus on that so that many are able to be paid. And that is the we didn't want to do it in this supplementary because we want to conclude the process fast. But once we clean up our books, we are now moving to accrual accounting from July this year, so that going forward, all our if you do not pay any bill, it will still be part of the financial statement and will be reflected. We have a number of other reforms, including moving to single treasury account and others. Then we are also focusing on use of PPPs, because now we don't have fiscal space. We want to bring more of private sector, like for instance the road to Nairobi to Rironi and many other areas where they are commercially viable. We are even looking at even where we have taken loans before and they are commercially viable ventures. We could as well exit and allow private sector to run that. So I really don't want to spend more time. I just wanted you to see that this is how it has been, and the development spending is supposed to progressively increase. because we feel that we need more to impact on the growth. But more importantly is that we are on a fiscal consolidation path where we want to raise revenues, contain expenditures, so that over time, by 2028, we are talking of a very low budget deficit. Our aspiration is actually to balance the deficit. In other words, to balance the budget. But it is a conversation that we need to have, and I think that conversation you asked is important. We discuss together and see. We have tried to be as transparent as possible as Treasury. All our documents are on the website. Even what we took to Parliament, you can get. And I think Julian Amboko was asking me questions early this morning. You get all our issues on the website. We are transparent enough and we want to be accountable to Kenyans, because what we raise, and of course we ask also Kenyans. I mean, it's good when you are raising taxes, you also want to ask how are the taxes being used. And I think these are issues that oversight bodies will have also to look at. So finally, we are now talking about primary surplus. Going forward, we want a primary surplus, not a primary deficit. When we say primary surplus, it is, look at yourself. If you have loans, you have borrowed, you look at all expenditures minus interest cost of whatever you have borrowed, because that is what you use to judge how good you are in terms of your fiscal position. So I want to tell you, this is our desire. We have made progress. You can see we started with 8.3% in 2020. Then budget deficit has come to 5.6, this 6.2. Then 2023 is 5.6. June this year it came to 5.3. We wanted in the budget we took to Parliament to go to 3.3, but because of the riots that came, what happened? We had to pull back. We targeted 4.3, but because of the challenges we have gone through, we have made that adjustment from 4.3. What we have taken to Parliament now is 4.9%, which is still progress towards where we want to go. And so you can see that we want next year to go from 4.3 to 3.5, 3.2, and 2.1. And I think things can change if we are able to expand the economy. If the GDP grows, because now we are talking about that 18 trillion GDP. If we are able to increase that GDP, then I think these numbers will come down and things will be much better. So we really need to have a conversation on this matter. There are downside risks. I just wanted to inform you about the IMF. We have finished the program for IMF is coming to an end in April. We have only one more review. We call it 9th review because there were 9 reviews. Our intention is to continue to be in an IMF program because it is good. It gives signals and confidence to everyone. So we are going to be having discussions on 9th review as we also talk of a new program with the IMF. Meanwhile, we are doing other actions to make sure we balance our books well, and you will be seeing us in the market for other measures. Now, we don't like to blow our own trumpet. How do others see Kenya? Because it's good also for independent people to rate us. And I think we have been rated well. In the last 2 years, we have made efforts. Moody's has actually issued its rating and has upgraded Kenya from negative to positive. It jumped from neutral to positive. That shows we have made efforts. And then Fitch Rating Agency has also retained it at B- with a positive outlook. And there's a draft I've just seen from this S&P, which is coming out, I think, next week, which has also put Kenya on B- positive. So I am not just blowing my own trumpet or our own trumpet. Others have seen that we have done well. But it's not good to be complacent. We don't want to be complacent. We want to work together to make sure that we continue having our country performing better. So there are some risks. but we hope we don't get major shocks going forward, including even what Trump is doing. We hope that that will not really hurt us most. So I want to conclude by saying that your theme is important for this forum, positioning for recovery in a fragile environment. It has been a fragile environment. We have had shocks, multiple shocks, domestic shocks, including climate shocks. But like that tree, we have gotten used to challenges. And we always come out of those challenges in a resilient way. And so this Kenya is a great nation. I think if we all agree together that we build our nation, and then we don't just see Kenyan market, we get to the regional market and the international market, I think we are good to go. So I want to conclude by saying we are ready to work with you. I spoke with my cabinet secretary who was supposed to be chief guest here today. He's in South Korea, and he also asked me to give his pass his greetings to you and to give the commitment of National Treasury under his leadership on need for continued dialogue with you. So we'll be engaged more. We have decided to open up. You have seen a lot of outreach, sometimes even come out of National Treasury to talk to Wananchi. And my CS has gone to Raya, the Jivanji Gardens, to try and meet the common man, because we want to demystify this treasury. We have nothing to hide. This is your institution, and we are just custodians. So I want to end here by saying thank you very much for inviting us, and I'm looking forward to greater dialogue. Caro, please invite us under KEPSA. Asanteni sana.
Let's appreciate the Principal Secretary one more time. That is Dr. Chris Kipto, and thank you for a very detailed presentation on the state of macro affairs. There's one thing I like about the PS is that many times when I'm combing through the documents, whether it's QEBR, BPS, medium-term debt strategy, I'll send him a message at midnight, and the PS does respond. Sometimes we don't agree on many things, but at least on giving feedback, he does give. So let's appreciate him one more time. Thank you. So tech team, please help me move this lectern to the extreme end. We get our seats back because we want to get into the panel discussion on this subject, and we'll allow the PS to leave because he has other commitments. We want to discuss what has just been laid to us. And I have my panel here of 5, both private sector and think tank, and we want to demystify some of the things which we have been touching on this morning. So allow me to call on stage the Chief Executive Officer of the Institute of Economic Affairs, that's Mr. Kwame Owino. Let's appreciate him as he comes. Yeah, please, you may take the central seat. Can I get help in just moving these 2 seats, the ones that were moved to the extreme end as well? Let me call on stage Ms. Carol Kariuki, CEO, Kenya Private Sector Alliance, to join us as well. Karibu sana, Madam Carol. Speaking for the private sector, yes, bring it just here. And then let me call on stage Dr. Julius Kipngetich from Jubilee, Group CEO, Jubilee Insurance. Karibu sana, Doc. Next is from Bajeti Hub, and that is Dr. Abraham Rugo. Karibu sana, Doc. As they come, please, I need microphones on stage as well. Yes, please bring them. And finally, the head of research at DTB, Faith Atiti. Let's appreciate her. She makes her way here. Faith, please, this is your function. Thank you so much for hosting us. Karibu sana. So, ladies and gentlemen, we have seen the presentation from the PS. And one thing stands out to me, and many Kenyans normally ask me this question, is that when we look at the macros, by and large, the macros look pretty good. Interest rates are coming downwards, inflation is down, FX has stabilized, and you remember what PS said, CBK has been active, so this thing could as well be at 100. That's some forward guidance, I guess. Let me start with Kwame. Kenyans will tell you kwa ground vitu ni different. And we always ask, where is the disconnect? Why is there decoupling between the macro numbers and the micro realities. Kwame.
All right. Good morning, everyone. So two things. One is that macro numbers present very big aggregates. And one of the things you've heard over the last couple of months is the fact that inflation is dropping. And it's true, it's dropped. But if you look keenly at the inflation basket, and you talk about core inflation, which is everything except for the very volatile items, energy and food, the others are actually dropped. That's true. But the drop could not be, in my assessment, and I think I'm right, is not because prices have dropped. It's because demand is weak. People don't have income. Wages have not been rising. For that reason, demand is weak. And so that's what is being recorded. On the other side about food, and I am grateful that the PS presented to us a chart of selected items which have really dropped, but on a historical level, they're still at very high rates. So if you think about food, for instance, the inflation basket in Kenya, which measures 300 items, 30% of those items are food items. If you think about the last 5 years, something really peculiar happened in Kenya. The relative price differential between food and non-food items is such that food items in general, wow, there's a relative price shock. So if you compare food items in that basket vis-a-vis non-food items, the inflation for non-food items for food items has been really, really high. So that irrespective of the fact that prices are dropping, but they rose for 5 consecutive years at such high rates, and they rose at a level that is much higher than incomes. So if you think about that, Kenyans are saying that yes, there's some relief, but it is not substantial. That's the point. And the third point that we need to speak about, and I think this I need to speak about, perhaps it's good to give credit where it's due. I'm not thinking that Kenyans, you haven't asked me this, but I have to say it. The problem with public finance is not an expenditure problem. Let me tell you why. It's true as the PS said that revenues as a share of the gross domestic product were 18% at one point. They've dropped since to about 14 and are edging towards 15. But this is an economy that is bigger, and government spending has been high, where the deficits have been 4, 5, some years they were as high as 6%. But the poverty rates today are back to where they were in the mid-2000s. So if you measure Kenya's poverty today, people are poorer today than they were in the year of COVID. So if you take all those things together, Kenyans they're not guessing. They're saying, fine, you're giving us fine numbers, but I can't afford enough food. So you'll see this. Poverty rates mean at 40% of the population means 21 million people do not have sufficient funds to feed themselves, which is bigger than Kenya's population when I left high school. Well, before I left high school, sorry, as I was joining high school. That's material. So we must give credit. But what I'd like to sit here and say, Kenyans, we have serious work to do. And we can't wipe away this thing with flowery language and PR messages. Thank you.
So Kwame is telling us we have a real incomes problem, right? That whereas the macro numbers look good and they are coming off a high base, in terms of real incomes adjusted over time, we have a problem. And that is why the spending power feels depressed. Carol, you hold brief for the private sector, Carol. And PS has told us pending bill's priority is for the micro small businesses, 30 billion worth. Just how much of a relief would that be from an economic pulse standpoint in the private sector?
Thank you very much and good morning. Let me first thank the PS and for that optimistic picture. And I think as I was sitting there and I was thinking about the private sector, and when I talked to the private sector and I asked them, what do you think about 2025? They say they are cautiously optimistic. And for 2 reasons. Optimistic because of what you've shared. And we can see that if we do what you've said, then things will turn right. Why are we cautious? It's because of how things are today. And so the whole picture is moving from where we are, which Kwame has really articulated, and I'll maybe say 1 or 2 things just to emphasize what he said, to where we need to be. And this is the drivers of competitiveness. One, the cost of our raw materials. The reason why our neighbors, now you cannot find Kenyan products like we did, producing in Kenya has become very expensive. And unless we deal with that side of the inputs and the production side, then we'll not get to basically the tax regime and the regulatory environment. We have great policies in the country, great regulations. It's getting them implemented and how they're implemented. You know, we find that, and I know we use this term casually, cartels, but it's true. Individuals hold us captive. You can find a whole sector is held captive by one individual because they have access to certain things. Yet it should be a fair playing ground for all business. And then we'll get to that picture. Secondly, you know, we've talked about inflation going down, and this is great. But maybe what is not getting to the policymakers, which is what Kwame has alluded to, it's because of this whole new idea, which is a great idea in the long term, of generating revenue, but where are we generating it from? We are mostly targeting the middle class that fuels the economy with the taxes. Half the people here, if you ask them, their salaries today are what they earned 7 years ago because of the new taxes. So what happens to our food? So we, the manufacturers, we, the business people, have to produce. We've invested. You know, we've invested, and so we have to continue to produce. But what is happening is that if you go to most supermarkets and shops, there are all these deals because people need to sell. And so the prices are going down because people need to sell. Today, go to some of the biggest supermarkets today, and what you're finding is Kadogo market. Hardly can you find the 2 kg, the 5 kg. You're finding the small packets because that's where Kenyans are. So we need to look at what is not right, then we say what are our opportunities. And so the prices can seem like they're going down, but it's because people don't have money and businesses are producing. But can we sustain that? I don't think we'll be able to sustain that for a long time. And that's why we are losing our competitiveness. The third thing is, and this is where our opportunities lie. Because of where we are as a country, we've invested a lot on infrastructure and all. And to continue to do that, some of the infrastructure that we could really utilize as an opportunity right now, just need to drive to Mombasa and see the SGR, the cargo that is coming to the country, and all these cabins that go back empty. If we incentivized business on the export side, you know, and say that if we are coming to the city or to the inland, costs you this much. For you to export, you pay half of this price. Those cabins would not go empty and would increase our produce and our exports. But again, is what is happening globally. I think that's where lies our biggest opportunity. As the US moves to be more protectionist, is where now, and they're turning more into business, we turn to business. Instead of complaining what we are going to lose in terms of aid, is to say, can government then move its expenditure in those areas of health and education and leave the private sector to invest in these other areas and then work with the businesses in the US and others. Europe is shrinking. There lies the opportunity of ACFTA. This is a time we need to be able to do most of our business with the rest of Africa because we've always looked at Europe because of historical ties and all that. But then look at Russia. The Russia war continues, so the energy prices continue to rise. But Africa has 60% of the renewable energy in the world. So it's our time now to exploit that energy to our benefit while Russia and Ukraine is happening. Again, for ACFTA, Israel and Hamas continues, making trade very expensive, the trade route. Then can we trade with ourselves? This is the internal looking, but then it is good for us, not only as Kenya, but as Africa. And so those are some of the things that we can be looking at, and not, so that we move away from, yes, the micro, keep an eye on the macro, because that's where we need to go to, but move down to the micro on where the real challenge challenges are. And I like what you said. Let's have these conversations. I mean, we did a lot of those conversations, PS, in the earlier days. And it's time to go back to those conversations so that when we talk about inflation going down, we understand why is it going down. Is it because the numbers are right or something else is driving that? And how, so that we address the real issue.
Thank you very much, Carol. Allow me to swing over to Dr. Julius Kipngetich. Julius Kipngetich holds a business which sells a very difficult product, that's insurance. If you look at the insurance penetration in this market, it should tell you a thing or two. Doc, we're talking about positioning for recovery in a fragile environment. If you look at what PS has presented to us, especially with this forward-looking guidance on FY 25-26, are we putting our priority focus in the right areas to position for recovery?
Okay, thank you very much, Julian, and thank you, PS, for the great exposition of where we are. I want to look at Kenya in the following way. One is what the PS presented is for the formal economy. But you see, Kenya, you can look at it in 4 different segments. There is the formal part, which affects probably, my estimates, probably not more than 10% of the population. But they dominate the formal sector, and that is where that data belongs. But you see, there are 3 other sectors that we need to be thinking about, and that comes to what Kwame was talking about. There is the rural, agricultural. Then there is rural pastoralist. And then the people who are severely hit are the urban poor. So if you look at those 4 segments, we need then to almost have macroeconomics for each of them. So that then, because you see, when you see them, one group rioting, but you say, but the macro numbers are okay. But you see, these things are affecting each of those sectors differently. So we need to segregate and say, how is it hurting the urban poor, who are the most vulnerable? Because you see, somebody in rural agricultural can feed themselves, subsistence, and so therefore they may not feel inflation that much. But the urban poor are hit most, because you see, if you look at Nairobi, 55% of Nairobians live in informal settlements. You don't see them because they live in very small spaces. But they get hurt even by a change of 1 shilling in bus fare. They get really hurt. So we need sort of to look at that. Then the other thing is, if we were to attract investments as a country, we need to look at what are the things that drive. They are managerial in nature. So they can actually look at the macroeconomics and say, this is a very good economy to invest in, but the things that afflict us are managerial in nature. Things like corruption, things like bureaucracy, inefficiency, regulators are too slow or too bureaucratic. So those are the things that, some of the things you don't see in the macroeconomics, but they are very important in attracting investments. Because with this macroeconomics and even the rating agencies looking up, we need to address those managerial things. For example, if I want to invest in processing avocado and I want to, say, settle in Murang'a, one, is there land in Murang'a? Land in Kenya is held by speculators. How fast can I settle in Murang'a to actually run a factory? No, those are the things. Is electricity quickly available, or there will be a bureaucratic delay in acquiring that? So there's a lot Kenya needs to do to maintain its competitiveness by dealing with its bureaucracy. And that is why countries like Rwanda, we need to watch it, because they are addressing bureaucracy. And so there's quick decisions. You call it dictatorial, but it works. Yeah? It moves quickly. Decision making moves quickly. So we need to do that. The other aspect of attracting investment for resilience is we need to sort of observe what happened in South Korea in the 70s and the 80s. And that is how they encourage local companies to grow, what they are calling chaebols. If you look at things, institutions like Samsung was a textile company originally. In the 70s, government chose 9 chaebols initially. Now they are, I think, almost 30. And they said, okay, guys, you are family businesses today. How can we build your growth and enable exports for South Korea? So they worked on the chaebols. All of them were listed, and capital was raised. And today, they are multinationals in their own right. Now, part of that chaebols was to link with multinationals. So we have our own chaebols like Safaricom. How can we build Safaricom to be the Africa giant? Because if you look at MTN in South Africa is building a chaebol. So we need now to say, Kenya, how many chaebols do we have? For example, if you look at, say, Comcraft Group, the Chandaria Group, could we then grow them so that then those challenges the PS was talking about, exports, okay? We could identify 20 chaebols for Kenya, and we say, okay, we will remove all obstacles, we will support you with all regulations, so that then you can provide employment and exports. So we need to think like that, but those things are managerial in nature. So my view, Julian, is Kenya needs to address these managerial things quickly, because our competitiveness is being eroded pretty fast. Thank you.
Thank you, Doc. So we have soft issues to deal with. That's what Dr. Julius Kipngetich is telling us. And I'm surprised you haven't recommended your favorite book. He likes a book titled The Mystery of Capital by Hernando de Soto. He's a big fan of it. PS, yes, you may leave. Thank you so much for joining us this morning. Faith, this week, rather, the last 2 weeks have been heavy. We have seen the budget policy statement, we have seen supplementary 2, we have seen the medium-term debt strategy. And when you look at that fleet of documents, are you optimistic, even as you talk about repositioning for recovery?
Good morning, everyone. Can you hear me? Okay. So yes, as you say, I think the tone across all the issues, the sentiment has been expressed here by the PS, and it comes out clearly through the supplementary budgets, through the budget policy statement, that indeed the government and many of us in the room are a little more optimistic than we were a few months ago. It doesn't take away the fact that we are not where we are yet. We've seen significant revenue gaps, which have to be filled, one, by either raising more taxes, and secondly, by coming back to the market to mop up some of the liquidity that the PS was talking about. From a financial sector perspective, I think we've seen some strain over the last couple of years. From the PS presentation, it was clear that credit to the private sector has contracted over the last year. One, because liquidity was a challenge in the market. Secondly, because also the macro environment was a bit challenging, in the sense that with government slowing on spending liquidity into business, remember government is the single largest spender, so every time there's a contraction or slowdown in spending, it ripples across the economy. So there's been some slack in just how fast or just how much banks can extend credit. And if we are to accelerate that journey, then we also need government to be a bit slow on how much liquidity they are taking from the market. So from the budget policy statement to the supplementary, it's clear that they will be coming back to market to borrow a lot more. It's encouraging that, yes, liquidity is back, so the effect or the strain on markets will be much less. But we really need the government to really slow down on their borrowing side to enable then banks to extend that credit. Otherwise, it becomes really difficult to live up the hope if there's no enablement from a credit perspective for the private sector. But that said, the macros are looking up. I think markets are receiving it a lot more positively. It may speak to the 10% formal segment, but I want to believe it has a spillover effect on the broader economy, because the 10% would sit at the peak, but there's a whole value chain which stands to benefit from this rather optimistic scenario that markets are seemingly sending out. If you look at the NSE, which ideally it's always believed that market price in expectations about the future. And if NSE is anything to go by, then the signals are very encouraging. So if we can harness that optimism at that level and we have it trickle down to the whole value chain, then I think everyone will be in a better off position than we were a year ago. So a bit on the optimistic side, I think government is doing a lot more better. We're expecting more liquidity if they start paying down these pending bills. As they say, 30 billion may not seem much, but for those who follow the central bank, they reduce the CRR, and that has injected about 50 to 60 billion in the market. And we've seen the substantive effect that can have on the economy. So I will not discount 30 billion coming back into the market, because that really supports that key economy that would also just trickle down on the household, on individuals, something we really need to embrace currently. Thanks.
Faith is telling us that we need liquidity infusion into the economy, talking about the 30 billion which the PS did mention, as well as the revision of the cash reserve ratio, which should unlock, by my math, about 54.7 billion. Let me cross over to Dr. Abraham Brugo. I saw you nodding when Kwame was speaking, when I asked where is the decoupling between the macros and the micro. I'm sure you'd like to chime in on that. And also, as we talk about repositioning, the PS touched on the critical issue of the IMF program coming to an end. Many here are wondering, what does that mean?
Thank you very much. I really appreciate this opportunity. I think allow me first to start by saying that any economy has to deal with its level of development. And when you look at Kenya, and indeed the rest of Africa, you are talking of a mean age of 19. I doubt in this room there is anybody at age of 19. So we are speaking for people who are not in this room. A mean age of 19 means that almost 75%, 79%, the last check I did, of Kenyans are below the age of 40. And that tells you that then the developmental needs that you have for that population are perhaps slightly different from the emphasis. When you look at the emphasis we've had over the last couple of years, the last 10 years, which has really pushed debt up, huge infrastructure developments. We can discuss the value for money because, and Kimgetich, allow me to disagree with you. I don't think corruption is a managerial issue. It is a huge value existential matter. It has passed a managerial control. It's no longer about controls. It's about rule of law. It's about the DNA of a society. Because that's eating into, the infrastructures we have done, the value for money for them. But then how much have we put into education? How much have we put into healthcare? How much have we put into sectors that actually provide hope and create hope? And therefore, for me, the biggest disconnect has been there's a bit of a disconnect between the talk and the actual action and where the money is actually going. So that's important. Secondly, I think we have over-relied on government being the driver within the economy, and I think I agree here with you, Faith. Though again, I could see it a bit differently. Because if there is no incentive for banks and financial institutions to lend to improve the private sector space, to lend to people who are doing the micro and small enterprises, who basically do not have the kind of collateral or assurance that government would have, then it means that the net effect is that the space that which you're trying to collect tax is limited, and that's now what has ended up being that you are basically punishing formal employment. which is the case right now. You know, anything, any new taxation you are coming up, any new levy, any new framework that you are coming up with, basically is targeting that. The third point, which is why I was really agreeing with Kwame, is that not improved. If anything, they have not only declined for those who are earning, but many more people have lost income. So they no longer have income opportunities. And that you see, whenever manufacturing sector is declining, then you know very well, there's nothing new, you know, you're producing. When you don't have the post-COVID recovery, you know, which definitely had its own impact. About 2 million family-owned enterprises closed down. Not many of them recovered to the position where they are. And therefore, if we don't directly tackle, say that we still have to address programs that deal with the developmental needs of getting people out of poverty. 20 million Kenyans in poverty is not a joke. The Business Daily title today, 7.6 million people who cannot actually eat, do not have proper nutrition. What are you saying about their mental development? And majority of those are basically children. But let me come to the international institutions and the IMF. Yes, the IMF program has helped to send the right signals to stabilize, but in some way you could argue, and we have argued this to the IMF, that actually that has perhaps encouraged bad manners. Because this is budget support. You sure you will get this money. So why should you why should you deal with corruption? You know, why should you deal with fixing your market? You know, if you very know that you will definitely get this assurance, you know, you have this money coming in. Of course, I mean, the conditions that come with it, some of which have not even been honored. Take an example, the state-owned enterprises. I mean, fellow Kenyans, we are dealing with state-owned enterprises that do not necessarily perform, but consume to the average about 600 billion. They are the ones leading with the pending bills. But we continue pumping more money into institutions simply because, and perhaps we try to avoid these things, but because these have become the places where we politically reward people. So even when we are talking about employment, the question should be employment for who? What are we trying to guard? The report, the Abdikadir report, and Ms. Karaoke's report of TIN, on what we needed to do with the state-owned enterprises. We're talking of 10 years ago, 2014, 2015. I mean, this is when we are matching the first 46. I mean, we are joking. Which business will continue pumping money into an entity that is non-performing for the sake of creating employment? Government does not exist to create employment. Government exists to create a framework conducive for employment creation. And therefore, this idea where everybody, doctors, teachers, everybody wants to go into politics, wants to go into government because that is a sure way, it's a sure bet of how to make money, I think this needs to start ending. And government definitely needs to take its responsibility of improving the regulatory environment so that then money goes to where, because all countries we celebrate, the Singapores, the Germanys, are driven by small companies that employ 5,000 to 10,000 people. Because that is where 1 shilling that is circulating is more than $1 million that is stuck in a bank account. Thank you.
Mic check, we're back, yes. Thank you very much, Doc, for that. I want to ask one round of questions and then I throw it to you so that if you have any questions, please shoot up your hand, you can introduce yourself and direct your question to one or multiple panelists. Kwame, the point which Dr. Rugo has left it at is where I'd like us to pick it from. We have, if you look at the KNBS numbers released every year, 7 out of every 10 jobs created in this country are in what we call the informal sector. And many times, government argues that the way to jumpstart this segment of the economy is for them to first of all formalize. I had a very interesting experience with my mechanic when I told him, starting now last year, whenever I come for service, please give me an ETIMS invoice. And he told me, and he just didn't see the point. Kwame, where do we start with jump-starting this segment of the economy?
Well, so, look, if you're a student of economics, you understand that employment exists not as an end to itself, but it's to provide somebody with an income and sustenance. So regardless of whether it's in the formal or the informal sector, it's a job. So that distinction between formal and informal came about because of people who have the idea that everybody should sit in an office. It's easy to collect taxes from them. So I work in a small firm, a think tank, 28 of us, and it's my responsibility and part of my KPIs to ensure that all statutory deductions are made before 9th or 5th, whichever ones of those it is. So I'm doing the government of Kenya's work for itself by ensuring that my colleagues work, the money is available, and I send one check to them every month, right? That's easy. So when somebody else works in an arrangement in which that is not possible, we call them informal. And I think that distinction is very artificial because it's based on convenience for government. And yet an economy exists regardless of what government's arrangements are. So I'm not too sure that this obsession with formalizing the informal is even a sensible thing. What exists as the informal sector is the reality of how lives are led. So for instance, most Kenyans draw their sustenance from small farms in Siaya, in Migori, in Nyeri, or wherever. And the way they work is they work for themselves. So I don't know what it is you're going to tell them to formalize because you want to give them an ETR machine to place in a hut. I don't know. So part of this tells you something about the way policy is made by people who want convenience for government as the imprimatur for how we run businesses. And they'll continue to be frustrated. So you've had this pressure on the backs of what we call the KRA, the revenue authorities, to widen the tax base. To what? To widen the tax base to what? I'm also not even persuaded, as everybody seems to think, that there's a lot of money sitting out there, outside, that some people are hiding. If you really look at the poverty reports, go look at the Kenya Poverty Assessment Report issued in January this year by the National Bureau of Statistics. Kenyans lead dreary lives, guys. I'm not saying this to shock anyone. It's true. Kenyans live dreary lives. So we have a problem with taking a tax management mechanism run by Sweden and the US and imposing it on a country in which most people still run small agricultural farms. We have a problem. So if you're thinking about taxes and collecting taxes, the way to probably collect them when you're dealing with a very highly unstructured but small farms, because these are very, very small farms, is to think about how to get income or revenues through their expenditures. Otherwise, you'll be forever stuck with the 3 million like you and I, very lucky people with a track record, with a monthly income, with a bank account which can be tracked and from which revenues will be drawn. So I don't know that I'm giving you a solution. We are probably chasing a mirage. For as long as Kenyans simply still work within small farms which make advantage, for them. So in the morning, they're working in a farm, tilling and looking at the rain so that they can grow their maize. Then in the afternoon, they're selling some mitumba clothes off the village market. And the evening, perhaps they have an ox or something that they use to plow for someone. They're doing 3 jobs in a day, hustling, properly hustling. How you attract by digitalizing or thinking that you can do that? I think we design government services, or we design these things separate from the way people earn income. But what do they do and how can government raise revenues? I also don't think, perhaps this is heretical, but I don't think that we should judge government success by its ability to collect taxes. Now that's not an idle point. We worried about this in the Institute of Economic Affairs, and we looked at the last 30 years when I was still a schoolboy. And one of the things that we found, that the fastest growing economies in the world that have done annual growth rates of 8 and 9%, not the 5. 5% for the next 20 years is not going to get Kenya anywhere. In fact, what the PS should be thinking about is not to get us back to where we were, to actually shift gears to a super speed, which is 8%. Because when you're growing at 8%, every 8 years, the economy doubles in size. If you're growing at 5, it means you have to wait 14. So basically what Kenya needs to do is to ramp up real growth rates to make sure that you're really getting that to happen. And that's not going to happen at just 5%, because 5% is decent, but it's really not getting many more people in the... And then the problem of the formalization will solve itself when people have higher incomes, when they start to form bigger farms, when they are all that easy. So the fact that we have a big informal sector is in a large part, not entirely, but in large part, the fact that those incomes are too small to start formalization. They can't have an office. the office is the home. So I think we shouldn't chase mirages. This discussion should be properly framed. And the framing is low incomes, and those incomes don't come on a regular level. People are not doing one same job, so they cannot sit in a structure which they call an office, which you can then come and tag a license to and stuff like that. So if you accept the way people live, or the way you assume Sweden collects taxes, and therefore you want to collect in that same way, we have the frustration that we have with arguing formal sector and informal sector, which for me is a distinction without a difference. Thanks.
Thank you, Kwame. Dr. Julius Kipngetich, how do we approach this space, what we call the informal sector? Because that's where the bulk of Kenyans are. If we are repositioning for recovery, we must address their needs.
Okay, thank you very much. I think, how many of you are familiar with how KTDA works and why we are #1 exporter of black tea in the world? Let me explain, because that will answer what Julian is asking. Because I sat on the board of KTDA for 9 years. KTDA, the average land size of a small tea holder is roughly 1 acre. That's roughly 1 acre. That 1 acre guy is the #1 exporter of black tea in the world. But look at how it works. There are 600,000 farmers, small tea holders in the country. All they need to do through their agent KTDA is I pick my tea and I take it to a buying center. That's all. That's my job. Now from there, KTDA picks it with a truck, takes it to a factory owned by the farmers. The farmers own the factories. KTDA is just an agent. KTDA manages the factory on their behalf, processes it, grades it, and puts it in a warehouse in Mombasa. The biggest user of warehouses in Mombasa is KTDA. And then this tea is then exported by KTDA to Pakistan, Egypt, UK, all over the world. Okay? What is happening there is the power of aggregation. Now, for us to deal with these small holders, we must then go into aggregation. And then those aggregators, hopefully, will be the chai balls of tomorrow, where they are listed in a stock exchange, so that then people like you can buy shares from looking at the profitability of that aggregator. It used to work in the 70s significantly, but because of those managerial things that we do, and we do very well in Kenya, otherwise known as corruption, we have destroyed those. So you see, for example, the grains used to have KFA, and then Kenya government formed something called KGGCU, and it dropped off. Okay, there was cotton, lint, and seed marketing board. Sugar had their own. You know, there were so many aggregators, and we actually looked very sophisticated as an economy in the 70s, 60s, and 70s, and then we went down. So that's why, for me, I'm very emotional about managerial. If we don't fix the managerial, it doesn't matter whether we have the best laws or policies. Managerial means everything. If we don't manage, so therefore, my own recommendation is that every informal smallholder group must be aggregated by an efficient aggregator like KTDA. KTDA only takes 24% of the auction price in Mombasa. The other 76 goes to the farmer. So just imagine a small farmer in Nyeri or Kericho with 1 acre and earns 76% of the auction price, and the rest, that headache is covered by a central set of expertise at KTDA. Supposing now we head for every of those, banks would now access. So the most sought after, in the insurance industry, in the bank industry, farming group
is KTDA. Why? It's organized. So if we don't organize these smallholders, they will dissipate a lot of energy just doing things which don't really make sense. And so I would like us to read through really the development model of South Korea. Okay? And then probably the last comment I will make on that, Julian, is the PS talked about agriculture. For me, agriculture should not be our priority at this time. It has been a 60-year song. The most elastic industry for Kenya is tourism. That's the most elastic. And the day we focus on tourism, the way the French, who are #1 in the world, and the Moroccans, who are #1 in Africa, okay? The Moroccans in the year 2001 used to receive 1 million. In 2024, they received 15 million tourists. What did they do? We need to understand on what really happened in that tourism, because we have a much better and stronger tourism product than the Moroccans. The tourism industry released data yesterday, and they were talking about 2.4 million foreigners that came to our country. Ideally, Kenya should be talking about 20 million, 10 times that number. So we need to say, what is it that is what we are not doing in the tourism industry, because it's labor intensive, it absorbs a lot of these people quickly, and it also strengthens this agricultural value chain, because then you have 20 million people who can afford to buy. Thank you.
But Doc, before I release you, how do you respond to the view that the reason why Kenya, if you read whether it's the MTPs and the Vision 2030, the reason why there's a focus on agric and manufacturing is because of their labor-intensive nature. It's because we have these masses we're wondering how to create employment for. I mean, tourism, we know the SaaS sector is strong in terms of inflows, but not so much in terms of the labor-intensive.
So I didn't get what your...
So you're saying we should focus on tourism?
Yes.
I'm saying the reason why we focus on agric and manufacturing is because of the labor-intensive nature.
Okay. Now, I think Carol had put it very well. Manufacturing is facing a critical challenge, which is cost of doing business and the bureaucracy. I mean, if you go to any factory, the level of harassment by county governments has just gone beyond, it's mind-boggling. So, to me, manufacturing, you can't compete with the Chinese or the Indians. Those ones have perfected it. Okay? So, let us look at areas where we have competitiveness. And to me, competitiveness is in tourism, because we have the product. You know, the best climate in the world is here. So what else are you looking for? God has given you on a silver platter. So, and then also the tourism industry by design is labor intensive. Just let me give you a statistic. In the tourism industry, for every 10 visitors, you create 1 permanent job. So if you look at France, France has 117 million visitors every year, double its population. Now, so therefore, the tourism industry in France employs 11 million people permanently, permanent jobs. So if we were to do the same in Kenya, supposing we were to do what our potential is, in my view is around 20 million in the medium term, that is actually 2 million jobs. Can you imagine us sucking 2 million, removing unemployed 2 million from the marketplace? So it is actually, and then the multiplier effect on agriculture will be huge, because a tourist, on average in Kenya, they spend 14 days. Okay, let me conclude. So the 14 days, oops. So if they are around for 14 days, they spend roughly probably $3,000. Okay, so you can look at that spending power, which will go largely to agriculture because they eat food. Okay, so the multiplier effect of tourism, in my view, is where we need to put our energy, because God has given us the product. It's just us to take advantage full. So even the banking and financial world, we will need to be leaning towards building several serenas. Thank you.
Let me support what Julius is saying, and I agree with him. And we're not saying we'll not do agriculture, we'll not do manufacturing, we'll not do banking, we'll not. Because we have such an excellent tourism product, you know, and we could start from location to, you know, to what we are saying about the climate, the best in the world and all that. I think, and we've had this conversation with the Caribbeans, and you know, the ones who are here, the ambassadors, they keep saying, we cannot understand you people. You have the best product that we have. We have 3 times, 4 times your number. You know, Barbados alone, I think it's they have like 10 million tourists a year, and they are like maybe 4 million population. What tourism does, if you're a country that has such a product, it stimulates every other sector. Just look around. And it's a good thing we're talking about it in a hotel. Look at the cups, look at the linen, look at the food. That's all manufacturing we're talking about. Look at the money that needs to be used, the banks that need to service this industry, DTB and others. So every industry will actually be stimulated. All we need to do as a country is address the drivers of competitiveness, focus on tourism. All these other sectors will be stimulated and they'll grow. Look at the building, the construction industry. You know, every other industry will grow. That's the one point. And it's I really just wanted to use practical examples, and I'm liking this conversation because we're going to the practicability of the examples instead of just giving numbers, and because we were given the macro, but now it's going to the micro. Let me give another example, and that was on the issue of SMEs and the whole informal sector. And I'll places when we were saying, why do informal sector, people in the informal sector, not want to formalize? Because what is in it for them? Am I going to formalize so that you send KRA to me? You know, and I'll give you this example of why they formalize without them being asked. And though this is a touchy topic right now when we talk about the housing levy, when the affordable housing started initially in the former government, and what the Ministry of Housing did, and this was shared by the PS then, so I have rights to share it, and you can ask him. He said, when we think about building houses, there are things that our own informal sector cannot do. They may not put up the structure, and we may get big contractors, foreign and local. But the informal sector have perfected art in different things, like door hinges and all that, and they do such world-class jobs. And so he went to just one place in Kariobangi, found these young people who were doing these door hinges. He showed them what he wanted, and they showed him a prototype. And he said, I would like that. Then he said, here is a government paper, produce for me 1,000. What were they? They had never formalized, they work on their own, but now they had a government paper which they could go and get money from the bank and do it. They came together, formed a company, because then now they do have something to go for. Got one of the top lawyers for law firms and went to the bank, because if they come to DTB with a big law firm, then you look at them and take them seriously. You know, they got the money. They got the door hinges, they produced the door hinges, got them done, got the next government paper, produced the next. And the first unit of the houses was done. They went back to the same PS and said, you know, as you allocate these houses, this is where we live, in this informal settlement. Could we be part of the beneficiaries? And why not? They had the money, you know. And the next thing they started saying, we're going to take our families for holiday in Mombasa. There's the SGR. What happened to that community? You know, it changed their lives. They formalized. The PS didn't go and tell them, formalize, then we'll come to you. There was something that was offered to them, and that's what we have to do in the informal sectors. You know, Microsoft started in the backyard. It was an informal sector. What made it formalized to become Microsoft? And those are the lessons we need to learn from such groups, and even as we look at farmers through the whole value chain. Once you put them in a value chain, you know, Bitcoin is going to be here, but there's a whole these value chains. These levels will formalize without being asked. So we don't need to focus on asking them to formalize. We need to offer them the opportunities so that they see the need to formalize.
So what's in it for them? Thank you for that. Let me invite Faith and Abraham to give their comments, then I'll open it to the floor. So in case you have a question, just be ready with it. Who goes first? Doc or Faith? Doc, all right.
Good. Thanks. I really appreciate and I really like this conversation. And the things we already have on our side are the things to take most advantage of. And I like the discussion around tourism, and I would expand it largely even to the service industry. You have human capital. You know, the one thing we know from the current generation, whether you talk about the Gen Zs or the Gen Zotes, whatever you call them, and their engagement, is that you are dealing with the people who are largely English literate, and I'm using that deliberately. I don't believe anybody is illiterate. They are just literate in different languages. They are English literate. They have access to internet. We have perhaps one of the highest internet penetrations in Africa. These are people who can access, and therefore there are different forms of even support that can be provided by this, because employment creation, even in the smallest of scales, and I want to really pick up on that point of what is in need. The approach right now to formalization has been so that we get you to the tax bracket. When you look at the array of permits and health permits and checks, and the number of people who visit a business on a weekly basis to check on different things is horrendous, you know, and therefore there is no benefit, as it were. And for the young people we are talking about, you know, remember my 19-year-old mean age, people who are trying to find space, whether they are trying to create a business or companies that are trying to expand so that then they can have more people in. All they want is to be able to, you know, to have, you know, a soft landing. Secondly, I think it's time to rethink our special economic zones, export processing zones conversation. We seem to have limited them a lot, you know. Of course, there is the discussion around the concessions being done for different spaces. But can this actually become a running thread across the country, where we actually bring all the players, financial sector, so that then they put credit into this. Regulators, so that they support. The role of county governments, so that they stop to be the killers of businesses, you know, and not just focus on nonsense revenue as it become, you know, the only focus. With the goal of ensuring that 5 to 10 years, we have space for growing own companies in Kenya that produce for our current market. Because right now, you know, the export processing zones, a lot of focus, of course, is on export market. What can we do to be able to make sure that then the production? Thirdly, is different regions in this country produce different kind of raw materials. How can we encourage a competitiveness across board between the pastoralists and the food producers? You know, between the people who are able to do, you know, fish farming and those who are doing chicken farming and all these kind of, so that then what Kenyans have become now, they try to do everything. I'm seated here today, tomorrow I'm a beef farmer, and then the next day I'm trying chicken, broiler chicken, the next day I'm trying all manner of businesses, and none of them is actually succeeding. So that then there is an incentive to be able to grow. But let me come back to one last point that I really want to emphasize. I think the discussion around how government reorganizes its expenditure patterns is long overdue. What the PS did not talk about, and I see is left, is that there's been a discussion around fiscal consolidation. This is a word I think I have had for as long as I've been in this space. But what does it really mean? Now, it was followed with two other conversations about the zero-based budgeting, which basically means going back to the basics. Are we spending all the items that we are spending on that make the collective of government of Kenya services, both national and county governments, are they essential? Are they critical? Are we putting our money, because that's what zero-based budgeting is all supposed to be. And that's a conversation that then helps us to reset that discussion, so that then we are not just worried about where will we borrow more cheaply, but then borrowing actually does service. And my very, very last point, then the borrowing we are making becomes a targeted borrowing that is actually helping us build these special economic zones we are talking about, start these new frameworks, support education, because we still have, with 20 million people under poverty, you still want to be able to provide mechanisms for children to go to school. You still want to be able to provide education, education services. You still need to be able to provide health services. I think that's some of the resets we need to do, because as long as government remains the way it is, it continues to crowd out just by the by the virtue of the fact that it's big enough. It's too big and consuming too much from the economy. Thank you.
Thank you. Let's listen to Faith before I open to the floor.
I think it's a very good mind opener, because for the longest time we've clearly approached the economic growth question in a very different perspective. Agriculture is the biggest sector, so we need to pump in more. Manufacturing is the way to create jobs, so we need to invest a lot more. But then we don't have the resources to do those direct investments. But I like how the conversation is going, the reset. Let's look, can we incentivize now the manufacturing and agriculture from a service perspective? If we can get tourism moving and we have all the resources, why not invest there? Why can government then incentivize more tourism? Because it requires very little investment, and I believe it's one area that the private sector will find it easy to invest. I think banks will be very supportive, and they've been very supportive. If you look at the portfolio of loans to this sector, is quite significant. So with the right incentive, I think if this conversation should really be encouraged. Government has manufacturing as one of its key sectors, but I think we can approach it much more differently. Instead of pushing for the direct investment from a public sector perspective, we can actually incentivize it through services. And like you well said, it may be difficult to compete with the Chinas. They're already very established. We can catch up at some point when our income levels, begin to pick up. But for now, if we can go that route, like incentivize services, so there's that ripple effect to the manufacturing, there's sufficient incentive for farmers now to produce more. I think we could be in a better place. Yeah.
All right. Before I invite Carol to come back, any questions from the floor? I can see a hand here. Any other? All right, so let's another one here. So let's give the two ladies and the gentleman here. So introduce yourself, to which institution you're affiliated, and ask one question. Just one. So do we have a roving mic?
Good morning. I'm called Maina Kanywa. I'm from a company called Private Equity. Private Equity is a consulting firm in this market. My question actually is like one set a complaint and one question. So Morim Mr. Kip was my lecturer back in the days. So I'm here, Morim, still pushing. The issue here is we've been talking about agriculture and tourism all our time, even when you're my lecturer. And there are so many things in this country. We don't talk about minerals, for example, and this country is endowed with a lot of minerals sitting down. We have oil, which we have never done anything with it. We have meat in the northeastern province, a lot of it. We don't talk about meat, exporting meat in maybe in the Middle East and other countries. We also don't talk about AI, and in a forum like this, and we don't talk about AI in an age like this, we're not tackling issues that are happening in the world. In the same page, maybe we should also be talking about data storage. I remember, Morim, you are my management information systems, so we don't talk about data storage and other issues like coding, which I think has huge, immense opportunity and growth. At the same time, we also don't talk about data centers, which I think can do very well in this country.
And finally,
we don't also talk about hydrogen and other issues about energy. Now, what brought me here? This is now my question.
So, what have you been doing so far, man?
Just introducing myself. Let me just ask, because I'm in a bank today. Let me just ask this question. We have issues with the bank. Every time we go to the bank for a facility, the first question they ask is, "What is your security?" I think we need to innovate on that issue.
Thank you.
We need to innovate on that issue and the issue of advanced bureau listing.
Thank you. Thank you for that question. So the collateralization of financing is a question he's raising. There's a lady there with a hand.
Good morning, everybody. My name is Dr. Juliana Momokisimbi. I'm an African Union and UN Economic Council expert. I have a very direct question on what is the role of technology in tourism advancement in Kenya, and the second one is, what other innovative ways can we use to enhance tourism? My last question is, how do we then utilize the power of the youth, who we call the Gen Z, who are largely unemployed, much as they are all not in the hotel sector? Then how can we harness that energy in terms of techno? Because at some point, we as African nations, we decided to have a revamp in terms of ensuring that all our countries are fiber optic enabled and that there is free Wi-Fi and internet largely everywhere.
Okay.
So I would like to see how that then can be used to enhance tourism. And just to wrap it up, we have 2 hotels right outside next to the Serena, and that is the Intercontinental Hotel and the Hilton, and they are closed at the moment. So if you have any investors and DTB, kindly revamp that one too. Thank you.
Thank you. So the role of tech, and also how do we harness the Gen Z population or power? Let's take that hand.
Good morning, and thank you, Julians. Thank you also DTB team for that forum. So I have 2 questions for Faith. From where you sit as DTB, I think PS said about how macros are stable. What is your outlook in 2025? And the second one is, we've seen interest rates going down. I've even seen people are talking about the 91-day paper and the interest rates coming to the Kibaki era. What opportunities do you see as we divert from that this year? Or where should an investor put their money this year?
Thank you. So those questions are for Faith. So let's respond to what has been asked. There's a question around the collateralization of finance, that we walk into a bank and we're being asked, where is the security? MD, would you like to respond to that?
Thank you for that question. I want to go back to a little bit of fundamentals of banking to answer that question. First of all, we all have to appreciate that bank gets money from depositors. So our first responsibility always when we come to work is towards depositors. The second point I want to say is that the country at the moment, for whatever reason, is at a high NPA, probably at about 10%, which means that the cost of lending goes up. And what happens when a customer does not repay the loan on time and the NPA increases? The good customers end up subsidizing the not so well-performing customers. So the banks, in order to protect its capital and the depositors' interest, need to have some level of security so that there is a skin in the game of the promoter in the business, and in case of a second way out. Let me tell you, banks are not interested in your property. We are not interested in your property or factory or anything else. But the fact of the matter is that if an account is getting unpaid and the bank needs to protect the depositors and the people who have provided capital, it becomes necessary to have some level of security. Of course, all banks also give lending without some level of security, depending upon the performance of the account and the rating of the customer. Thank you.
There was a question around the place of tech, especially in this AI age. Dr. Julius Kingatich.
Okay, I'll try to answer a lot of the things. On the issue of other sectors of the economy, today we are just talking about those that have mass impact. Mining tends to be enclaves, okay? And those are the things that we need to probably do more research, okay? The challenge that is that our mining potential now is still seen as too small. For example, if you look at the oil in Turkana, the quantities were too small, and then Kenya government did not have the capital to do more drilling. You have to drill, and I think the ratio is 1 to 40. Okay, for every 40 you drill, you succeed once, based on good seismic surveys. So do we have the capital to do that drilling? The answer is no. So mining, yes, has a lot of potential, but it requires a lot of investment, and the impact on the population is small. That does not mean that we pour cold water. The number one export for Tanzania is gold. It's not tea, for example, like us. But that gold is in enclaves, you know. So that's a discussion for another day. I think our general discussion today is about building resilience in the population, those areas which have huge impact on the population. On the issue of tech and tourism, of course, yes, like every other sector, tourism can benefit significantly from tech. But the nature of the industry itself is personal touch. You know, without these waiters of Serena serving you, supposing you are told to do self-service, you know, it creates a different feeling. So tourism is by nature very resilient and very people-driven, very labor-intensive. Technology will play their part in the bookings and, you know, demonstrating experience and things like those. But it boils down to that one-on-one touch. And that is why I believe, because I was in that industry for some time, I believe that God has given Kenya the best product in the world. There is no country with the kind of tourism product that we do. It's just a question of us taking advantage of that and building the numbers to come to our country. And the best country to copy is not South Africa for us, it's Morocco. If we can just copy what Morocco has done, our numbers will shoot. And it's not something, it's not rocket science, it's something very simple. So, again, probably I would not talk about technology so much. Probably next year's theme should be technology, okay, AI, and resilience. Thank you.
Thank you. Let me give Carol here.
Thank you. Let me just support Julius, but also say this. When we say tourism, we're not saying every investment you do will be on the tourism product. We're just saying tourism is a stimulator of all those other industries. So if we focus on tourism because it's a low-hanging fruit, we have the product here. All we need to do is segment it, package it, market, incentivize investment. Then all these other industries will grow. You know, they'll not only be that manufacturing will only produce linen or caps for the industry in tourism sector. They'll be able to produce every other good for everything else, but they'll have been stimulated because of this one product that we focused. Today, Morocco is producing, is a manufacturing center. It's big on agriculture. But where did the focus come from? They said, this is a product we're focusing on tourism. It stimulated all the other sectors as revenues grew and people had money, people had now ideas and all that. So even our minerals and our oil, all those will grow. But if we keep dividing our small revenue into so many little sectors, is what we are saying, how even us as a Kenyan, our mindset is that I invest on this, I invest on this, I invest on this. So we're investing in so many, and I can sit here and be very proud about all my many investments and the things I'm doing, but they'll never grow to be the Microsofts of tomorrow. They'll remain there, all good. But if we focus on something that helps stimulate the economy and grows every other sector as we deal with what we're talking about, the drivers of competitiveness, then when someone comes to Kenya, they'll know we are a tourism country, but they'll be able to see our manufacturing base, they'll be able to see our mining sector, they'll be able to see an agricultural sector that is thriving, that is export and all that, not just because it's feeding the tourism sector in the country. So it's good to clarify that so that it's not thought that we're saying forget everything else, do this. We're just saying this is a stimulator for the economy to grow in all those other things that we are good at.
Thank you. And the question on the economic outlook, I think we share the cautious optimism that has been expressed across the room, rather across the speakers. Our MD, the CEO, mentioned earlier, yes, we are optimistic. We go back to the 5% growth, if not higher, levels that, as a country, that's the average we've been doing over the last decade. The signals are there. There's a deliberate effort from the financial regulator, that's the central bank, to catalyze economic activity, and the environment is enabling at least them to pursue that sort of policy guidance in the sense that, yes, like we've said, interest rates are coming down, which of course makes access to capital, or rather the ability of the private sector to access capital much easier. As well, inflation is also come down, which also means the pressure that we've seen over the couple of years on incomes should be much less, so some spending power coming back. And of course, if the recovery goes through and the incomes continue to pick up, then of course inevitably we see consumption also begin to come around for especially the households. But of course, this is subject to a lot of risk that's still lingering. Of course, the government side, it's still fairly weak, the fiscal side, so we don't expect much stimulus, from the government. But it's also encouraging that today we are spending much less on debt, and that's why the PS was talking about the possibility of a budget, a primary surplus for the budget, and inevitably means at least the quality of expenditure will be at least much better. So we'll have more, at least a little more to spend on the recurrent side, or the development side, which historically we've seen it has a strong stimulation to the economy. So we're fairly optimistic. Of course, we continue to see how the external environment evolves. It's so far been positive. We've seen major central banks are equally reducing rates. Inflation globally has come down. Liquidity is also coming back to market. But also we continue to see how the policy pivot, especially around trade in the US, will affect markets. So far, I think they're taking it in stride. Yes, it is a risk that markets continue to price in, but I think the initial trade wars in 2017, 2018 pushed most economies to sort of, reform or reorganize themselves in a way that should there be another protectionist push across the world, then there's some level of self-sufficiency. So we do not expect it will be that aggressive, and even the impact on American economy itself may suggest that the president may not push as hard as he's indicating. Yeah, he may use it to negotiate, but I don't think he'll be pushing as hard. So from a general outlook, yes, it's much more positive. The risk landscape, yes, there's still some concerns, but it's slightly better than it was a couple of years. The only major risk I'd worry about if the geopolitics escalate in a way that we are not anticipating today.
All right, the key wild card is the geopolitics. We have 6 minutes to go, so 1 minute each for your closing remarks. Kwame, as you give your closing, maybe you can kick it off for us.
Okay. I'm a student of economics, so really I usually are very baffled when I hear people who have magical solutions for this sector will lead to explosive growth. And maybe they're right, but let me give you an anecdote and I'll end here. In the year 2022, right after COVID, I and some of my colleagues were in a planning meeting in Diani. And we were really surprised to show how good the product is. There was a family from Poland who were in Kenya because it's warmer in December, and they brought their grandmother who was celebrating, I think, her 94th or something year. And they had a suite. And so we sat in Diani for 2 days, and when we were leaving, they told us they'd be here for 14 days. They were leaving. And so I asked why. They were going south to Mombasa, south to Dar es Salaam, because the Kenya shilling was too strong. And for the 14 days that they'd have gotten for paying in Kenya shillings, they would get 22 days in, right? So that brings us back to another thing, which is basically the exchange rate. So this is where I land. Because we are speaking to banks, if you look at the Kenyan shilling, over the last 8-9 months, it's been very stable in the 128 to 130 range. And I don't know what magic is keeping it there. Let me tell you why. Because in that same time, the US dollar has appreciated against other currencies. And if you see that, what that means is that the Kenya shilling has actually appreciated by another 10 percentage points. So it's far too strong for export competitiveness to happen, for tourism products to happen here. So the economy is more connected than the magical things, solutions that you have. And if the PS was here telling that what we are celebrating as a stable currency has some serious effects on the ability to compete in tourism and the ability to compete in manufacturing. All that notwithstanding, it's true that there's some shoots that are happening here and everything else, but the economy is far too complex to believe in magical solutions. Thanks.
Thank you, Kwame. Going back to the shilling there. Dr. Rugo, give us your closing thoughts.
Yeah, thank you very much. 3 things. One, whatever we do, we must make sure that more people have income in their pockets. Whatever we do. And I'm just saying, because we all play from very different spaces. And perhaps for the banks here, and this is my critique to you, I think it's time to say that we want actually to spur economic activity and not just help government meet its balance sheet. Balance its balance sheet. Because that's what has been happening in the last 5-10 years. Banks have made huge profits from bonds and bills. It's a fact. In the same time, businesses have been closing. Your customers have been reducing. You know, how much is happening in their accounts has been reducing. So I think a society, people can come together and say, this is the direction we want to go. And even you can say that's a very selfish goal. We want a bigger customer base. Customer base is bigger only when people have money in their pockets. It's basic. That's one. 2, whatever we do, we must create hope. I have sat in a lot of these conversations and I normally live depressed. Not that my day job is any better because I analyze these numbers. And I think it's time to create hope. And this is my proposal. These conversations that we are saying we want to have, Banalaina suggested, can we actually bring the people we are talking about in the room? Can we bring the youth in the room? Can we bring the children? Some of you know the conversations you have with your children nowadays on the table are very different from the ones we had with our parents. Okay, we never had. Let's bring them in. They see the world differently. They have different solutions about banking. They have different solutions about where to access finance and how to make money. My son wants to make $1 million at 20. I didn't even think somebody could make $1 million at some point. So let's bring them in the room. And then lastly, whatever we do, let's deal with corruption. People, this has become a dangerous. I mean, the reason why collateral has become such a big thing is because you don't even know whether the person who is coming to borrow, even with that collateral, plans to pay back. It's a corrupt mindset. It's a corrupt, and yet in this same economy, we have microeconomies where even collaterals don't work. They don't even use them because trust is still high. And I will not go to examples. So, I mean, whatever we do, let us deal with corruption. And perhaps by starting to say, I will be the first one who is not corrupt. But of course, we then have to push this. And because we have policymakers in the room, we have enforcers. Guys, let's do this and do it for our country. Because that is what will make this place governable, manageable, and livable. Thank you very much.
Thanks, Doc. Dr. Julius Kingetich, your closing thoughts.
Okay, 3 things. Number 1, we don't have the problems other African countries have of skilled labor. We have it here in plenty. So let us utilize our skilled labor to produce that magic. Okay? This resilience is because we have a population that's well educated,
to survive in the circumstances. So let us go for it. Number two is Kenya has been too complacent with good. And to a point, it forgot greatness. We need now to jump out of this rut of good and we go for greatness. Economists like him are analysts of good, but we need scenarios of what greatness can be and go for it, because we are too obsessed with our past. We were better than Rwanda, Somalia. Guys, those guys have woken up, and we need now to start thinking greatness. Okay, so as we build resilience, let us think of, in the next 10 years, what Kenya can be, potential. And if we don't visualize it in our minds, it will not happen. So morally, you have seen India. The way it moved now is racing from being good to great. It's growing at 8%, the fastest growing economy in the world. Can you imagine the output India will have growing at 8% when you're dealing with a population of 1.4 billion? It's mind-boggling. Look at the amount of cement, for example, that an economy growing at 8% consumes. It's mind-boggling. That's what Kenya should think. Great. And number three, Africa is our playing ground. Let us look at Africa. Africa average age is 19. Okay? Asia is hovering around probably 32. Okay, average. Europe is in the 48s. America is 41. So everywhere is aging except here. Now, if we don't take advantage of our own continent, countries like China and India are already seeing that young population and seeing that population dividend. So let us think of that greatness, but that greatness begins by us entrenching ourselves in a continent we are domiciled in, which reflects the future of the world. If we do that, our exports will go up, our economy will grow bigger, because we have the skills here in Kenya. Thank you.
Thanks, Doc. Carol Kariuki. Everyone is talking about three things, eh? So mambo ni matatu.
I'll say two. And actually one of it, Julius has taken it out of my mouth, but I'll put it in different words the way I was thinking about it. So the two things. One is taking advantage of what Africa has. And the three things that Africa has to offer the world is arable land, 60% is in Africa. Is the young population that Julius has talked about, 60% of the young people in Africa. In the age of climate, we're talking about renewable energy. These are things that cannot be taken from us. You know, the rest of the world can come for anything, but the young people are ours, the arable land is ours, the renewable energy is over 40%. If we took advantage of things that cannot be taken from us, then we are talking a very different language, and we'll stop having the aid dependency, which I call aid dependency in the sense that we are like drug addicts. You know, the drug addict needs their fix, the drug supplier needs to supply, which is what we do with aid. You know, and that's why we never get out of it. But if we moved away and said, these are three things that we have in plenty to stimulate everything else, then we'll get away from this drug addiction called aid. But back home, for me, it's a clear vision. If today you ask me what Kenya is about, I don't know. It's agriculture, it's manufacturing, it's tourism, it is everything under the sun. And why? Because we are a very blessed country. We have all these things, but we have to have a very clear vision. Where do we focus to get greatest impact for that greatness that Julius is talking about, then stimulate everything else because we already have them. And allow, from a business perspective, as a business representative, allow business to operate and sell, and the jobs will be here.
Thank you, Carol. So Faith has ceded her closing remarks to the MD. Morale, you want to give some closing thoughts?
Can I take a minute to add something to what Dr. Julia said? Sir, I was in Singapore many years ago. It's a very tiny island with at that time population of about 3 million or something. And at that time, the weather there is hot. The best weather is slightly less hot, but generally it's very hot. At the time, they had tourist or visitor arrival of about 6-7 million. And I was seeing a national debate there saying the average time spent by the tourist is 2.5 days. How to make it 3.5 days, and that one day what would it do to the economy? So your thoughts resonate with me, and I think even a discussion around how do we make people who are visiting Kenya from 10 to 11 or 15 days can even increase this thing. So it's been a very wonderful morning. I'm not a morning man. I wake up early, but I just can't start working. But you people made me come here by 7 o'clock. But it has been a very invigorating whole morning listening to the entire set of panel, to our PS and to our board members and group CEO. And also, it is so encouraging to see such a full house turnout, and a big round of applause to these people for having been here. Thanks very much, and I look forward to more sessions like this, and you did a very good job of conducting it. Thank you very much.
Thank you, Mr. Morale. Let's appreciate him. So let's appreciate our panel. Thank you so much for being part of this. Please, you may rise to your feet. I'd like us to have a photo shoot here, and then you'll resume your seats as I guide on what next. All right, my camera crew, are we there? Yes. So this is the camera guy. Let's look that end. Oh, for balance, that's a good one. Thank you. Are we all right? Not yet? Okay. Thank you. Thank you. Thank you. You may resume your seats. Asanteni sana. Please take caution as you navigate the staircase there. Ladies and gentlemen, having concluded the panel, I'd like us to get into the closing remarks and vote of thanks for you being part of this. And I'd like to call on stage my good friend Al Karim, Head of Strategy and Finance at DTB, to come and do that. Let's appreciate him as he makes his way here.
Thank you, Julius. Good morning, everybody. We promised to let you off at 11 o'clock. I don't think I'll take more than 10 minutes, so I just request that you stay on for another 10 minutes, and you can then leave ahead of schedule. Was that an invigorating session, or was it just me? A real shout out to our panel for really making it stimulating for us, which is really the intention of forums that we've held in the past and this one's as well. Mine is just to perhaps summarize a few gems that I picked up during the discussions that we've had over the last 2.5 hours roughly. I think Nasim started us off by saying that at DTB we are more than just a financial services provider. And this Economic and Sustainability Forum, the 5th in the series that we have now held as of today, and which will continue. I just want to say it's not an annual forum. We aim to have at least 2 or 3 a year, and we tend to wait between an economic focus like today's forum and then on sustainability. But I think that line between sustainability and economics is really narrowing, and it's converging, as some of our speakers highlighted today. But Nasim talked about DTB being more than just a financial services provider, and it is through forums like this that we believe we're able to stimulate thought, we're able to create an environment for networking, but beyond that, hopefully, it becomes a catalyst for us in the private sector to engage with the policymakers. And it was really good that Dr. Kipto took the challenge posed by our chairman Linus about having conversations around both the private sector and the policymakers in the public sector, burning the midnight oil together rather than individually to solve the myriad of challenges that we face. Murli talked about and reminded us about the pathway of success filled with obstacles, and that overcoming these were going to be a sure path for us to secure our resilience, to safeguard our future, and to nurturing that very strong tree. He talked about 3 key areas: about adapting and keep growing, about the balance between stability and innovation, and also, importantly, about being socially responsible. And he outlined some of the measures we are taking at the bank to promote our sustainable agenda. Linus obviously built on that theme on sustainability by linking sustainability to resilience and competitiveness, which is really a thread that has dominated the rest of the discussions this morning. He threw this challenge for both the private sector and the public sector to burn the midnight oil together. And I would submit to some of our private sector leaders, Carol, perhaps we should take Dr. Kipto's challenge. He promised to lead the idea that was probably seeded in his mind today, to be a stimulant for a conversation more actively and consistently between the private sector and those in government. And I think we should, as private sector leaders, take that on with him. And we hope that a forum like this then becomes a catalyst for future conversations and ongoing conversations, so that the policymakers don't just hear us, they actually begin to listen to us, and that we're able to play a real influential role. Linus did talk about us playing to our greatest strengths as Kenya, which is our people, the human capital. And in a way, Dr. Kipto built on those strengths that we have. He talked about the diversity of the economy. And we saw a lot of numbers, a lot of macro indicators, which at the risk of repeating to you, make us feel good. But then there is this growing disconnect, as we were reminded, between what the macro indicators show and the micro realities that the common man faces. The soft underbelly is something that Dr. Kipto acknowledged, being the fiscal side of things in the economy. He talked about fiscal consolidation. I think we should pay tribute to the government. I think we, 2 years ago, leading up to this time last year, as a country, but in a very perilous environment, when the shilling collapsed, there was really a loss of confidence about Kenya. We were in the lineup to join Sri Lanka and Ghana and others with the real prospect of debt default. But let's give credit where it's due. Much as we may not have liked it, much as we've paid a high cost as an economy in terms of the interest rates and where they spiked up, and the damage they did in terms of, for example, access to credit for the private sector, these essential medication was necessary to pull the country out of ICU. We may be in HDU, some may say we are in the ward now, we're still in hospital, but we are not in ICU. So I think let's give credit to our government for navigating the country out of the crisis that we were in. There are, though, many challenges that face us. The government has been dragging its feet around the pending bills agenda, which has been there for a long time. When it's 700 billion that's pending and it's a real drag on the economy, we do get excited a little bit when even 200 billion gets mentioned as having been verified. And as Faith pointed out, even if the 30 billion of the 200 is paid off, it does have some trickle down effect on the economy. So let's hope that government will put action to its commitments that it makes and make sure that the economy starts lubricating again. Kwame did challenge some of the feel-good numbers that we see around inflation. Very well put, Kwame. Yes, sugar prices have come down, but have they come down to the levels of more than 3 years ago or 4 years ago? So our costs, yes, they're coming down, but are they coming down enough? and is the issue of costs rising faster than real incomes. That's a real issue. We have some serious work to do, and I think it was certainly a wake-up call for me. And I'm sure, Morley, I know we dragged you out at 7 o'clock today, but for all of us, it was a wake-up call when Kwame reminded us that 21 million out of 56, 57 odd million Kenyans are living in poverty. And if we are not going to do anything about it, then we could have, a social revolution of sorts, which will affect us and which will begin to affect our daily lives and our daily businesses. So the challenge is not just out there for government to solve. It is very much a challenge for us in this room and those of us within the private sector, and hence the reinforcement of having this very serious and consistent engagement between policymakers and the private sector to tackle some of these real issues that we face. Carol, thank you for highlighting from your perspective the issues that Kenya is faced with in terms of competitiveness. From a private sector lens, the cost of inputs jacked up by the costs of regulation and of taxes. The need for us to diversify fiscal revenue, tax revenue measures beyond just the middle class, so that it does not erode into consumption power, as we've seen, and the need to think afresh about incentivizing export industries. Julius, a consistent, strong supporter of DTB, thank you for your words of wisdom. You really broke down this disconnect at the micro level and the macro level by segregating the formal sector and then the rural agro, the rural pastoralists and the urban poor. And then Kwame built on it to say, what does an ETR machine in a hut do for Kenyans, given the subsistence nature of a large part of our economy? We need to tackle the managerial issues, whether we talk about bureaucracy or corruption. And Abraham, yes, it's probably an existential crisis that we face if we don't deal with corruption. Whether it's managerial or existential, it's still very real, and we really need to tackle it. We do talk about it as private sector participants, such as in fora like this, but then what's the next step? And what more can we do, or are we expecting others to do? Because if you're going to be expecting others to do this piece, it'll just remain a conversation, which it has for many years. So I think that challenge still needs to be resolved. We all know what needs to be done, but we are less clear about who's going to take that first step, and it needs to begin with us. Faith, thank you for talking about, and recognizing how some of these small measures government is taking, including a reduction in the cash reserve ratio, and how that plays out in terms of improving liquidity in the market. Dr. Rogo, Abraham, you challenged us about how do we tackle, amongst the many issues that we face, the issue of state-owned enterprises. Again, a matter that's been on the agenda, which has been there for many decades. We have formed so many commissions to try and sort this mess out, but revealing what appears to be the case. Are these state-owned enterprises really there to stimulate the economy, create bridges between the public and to access services and goods which may not be attractive to private sector, or are they just used as a form of political largesse? And can the government then be the catalyst for creating that enabling environment? A great sort of comment there. Government should not be creating employment, they should be creating opportunities for private sector to create the employment. I could go on and on, but I will be repeating, but I think there were some very profound thoughts that we are all going away with. Our hope at DTB is that all of us in the room, and certainly those who represent the private sector, will take this conversation beyond today's forum. But in summary, may I just once again add my thanks to our panelists, and I would like to call them up once again, one by one, so that we can just appreciate them. And so perhaps I would start with Kwame, if you could please come to the stage. And I'm going to ask Naseem and Murli to also join us, so that you can just give them a token of our appreciation. Thank you, Kwame. Thank you. Dr. Rogo, if I may call you up as well. Asante sana. Carol, and followed by Julius, please. And last but by no means least, our own and dearest Faith Atiti. Yeah. Faith heads up our research department. And may I just say that, and this is probably music to your ears, at no fee to you, Faith and her team are available to you in case you want to have one-on-one engagements, you want to get to know more about our perspective of the Kenyan economy. As I said, Faith heads up our research department, and she is available to talk to you, to your teams, to the associations that you may belong to, so that Faith can convey, our perspective around the matters economy. Right. Thank you. And lastly, yes, just one more. Our outstanding moderator for today, Julian's. Thank you all. Thank you very much. Thanks. I will in a minute. I just want to thank some very critical people who work behind the scenes to make it happen. I want to acknowledge Faith in particular and her team within research. I would like to acknowledge Agnes, our head of marketing. She's joined us recently. Wherever she is, if you can stand up and wave. Thank you, Agnes, and your team for putting this out. I'd like us to thank Azmaira Thobani, our head of sustainability and communications, and her team as well. And of course, our outstanding host, Serena, for today morning's event. And lastly, and certainly by no means least, a big shout out to each one of you for taking out this time this morning. We are really overwhelmed by the support you've given us, expressed by the numbers that we see in the room. And we would just like to thank you for that. And we look forward to seeing you in a few months' time when we host the 6th DTB Economic and Sustainability Forum. So thank you very much.
That's appreciated, Karim. Thank you very much. So ladies and gentlemen, that draws us to the close of our engagement this morning. Thank you so much for being part of this. We are still full house right at the end. We don't take that for granted. I believe there's still some breakfast outside here, so you may grab something, let's network, and you are free to leave at your pleasure and leisure. Thank you.
I also needed a bank where, in case I have an issue, I can call them. In case I want to visit their branch, I can visit it.
We have several initiatives, and now that we are here in Kikomba, we want to intensify it. DTB Sokoni must now come to life here in Kikomba. The Sauti ya Mama must come to life here in Kikomba. And our DTB Weza, this should be our testing ground, because we have very nice products for the small businesses. We should be happy that DTB
is coming near to the wananchi. Especially, we've been crying to some of us who have been doing businesses down there.
DTB is known as the bank that has supported the Chinese community and over the years, and we are happy to be part of the journey.
We have grown and we expect to do even better. We hope to serve as many customers as possible.